Hello, my name is Clive Corcoran and welcome to my YouTube channel, the Corcoran Codex. Now, just before I get started on this explanation regarding optimization of a small portfolio of ETFs, exchange traded funds, could I please encourage you to subscribe to this channel? There is no cost, no obligation per se, and the benefit is that you will then receive notifications as and when I add new material in the world of global finance, and I'm doing this on a regular basis. So let me just give a quick overview of what I will be discussing. This has to do with portfolio construction, portfolio management, and so on. And what I'm going to do is introduce a couple of ideas from portfolio theory. One is known as risk budgeting, which I'll come on and explain shortly. And the other idea is to try to come up with an allocation, sizing essentially, dollar sizing, as to how much to allocate, say, in this case to 5 separate ETFs, whereby the portfolio taken as a whole can then achieve certain kinds of optimization characteristics, where we can take, say, a forecast return for how we think each of these ETFs will perform. We can take some broad risk characteristics, which, as I'll explain in a moment, tend not to be nearly as variable, let's say, as the individual performance or individual P&L of the ETFs. And the technique that I shall use to illustrate this will be based on using the solver utility within Excel. What we can see on this slide relates to the Standard & Poor's 500 index, the US benchmark equity index, and I've looked at 4 decades, starting over here, 1985 to 95, 96 through 05, and so on. And what I did was, in this side of the table, I've said, what was the average annualized reward or gain, the P&L essentially, for having an investment in the index? And as you can see, we have close to 10% in these 2 years. We have a significant drop down to around 5% during this decade. This, of course, corresponds to the financial crisis of 2008. And once again, in the more recent decade, you can see we're slightly above 10%. So there has been variability during the 4 decades here in the return or rewards for having an investment in the index. However, the risk measured by the standard deviation in the returns, the monthly returns for the S&P during the same 4 decades, is remarkably similar, around 15%. The idea is that historically, the risk characteristics of investing in equities are far less variable than the actual performance, the P&L, or the profit or loss. So with that in mind, let us turn to the idea of risk budgeting. It is the process of identifying, quantifying, and spending risk, somewhat counterintuitive idea really, in the most efficient manner possible. And the idea is that once you can calculate the marginal contribution to risk of, let's say, adding another component to a portfolio, it allows you to make allocation decisions which will preserve specified risk tolerance mandates. And the idea is to calculate the change in portfolio risk due to the addition or perhaps subtraction of an individual holding. This allows the screening out of all allocations to assets that will enhance the overall risk profile. Theoretically, it should enable the portfolio manager to find the optimal allocation strategy commensurate with a certain specified risk appetite. So in general terms, the idea behind risk budgeting is to isolate the risk factors which have been observed to be the key drivers in the pricing behavior of assets. The conventional view, which is based on the capital asset pricing model, which has been looked at elsewhere, is to observe price behavior in accordance with a common risk factor, which is known as beta or beta. This idea puts expected returns or performance forecasts based on beta as the inputs to an allocation model for portfolio construction. However, in a risk budgeting approach, the fund manager selects holdings based on their risk contribution to the portfolio, hence the idea of the spending of risk that I just mentioned. This leads to a diminished role for considering expected returns. In other words, the allocation based on beta. With all that in mind, I want to now switch to Excel, where I'm going to go through this exercise to illustrate how when we come at the construction of an ETF portfolio, where we're focused essentially on risk budgeting, we can actually learn some significant lessons with regard to how to construct the portfolio, how to determine the optimal allocation, really based on seeing how this affects the overall risk of the portfolio. What we're going to look at is a portfolio that would be constructed during 2024, but it would be based on the performance of the 5 ETFs here. And you can see I've collected the historical data for each of these 5 ETFs. I'll describe them in a moment, starting at the beginning of 2023 and continuing down where there are 252 observations covering the calendar year 2023, removing weekends and public holidays. So within the Excel workbook entitled ETF Optimization, we can see the data that I collected that I just mentioned. This is for the year 2023. We have these 5 ETFs. I'll describe them in a moment. And we also have the S&P 500 ETF itself, SPY, which is useful for calculating certain things such as the beta value of the individual ETFs with respect to the overall index. You can see I've captured the closing price, I've calculated the day-to-day percentage changes, I've calculated various things such as the beta, that is done in conjunction with SPY. We've calculated the weekly standard deviation, daily standard deviation. We have the beginning price for the year, the final price for the year, etc. Then what I have done is move to this worksheet in the workbook, and we are pulling all these various ideas together from the data that I just showed you from that year 2023. So this is really now starting at the beginning of 24, the following year, of course, the next year, based on the observed data from the prior year. You can see here these are the 5 ETFs. This is a rather interesting ETF, which has the symbol BTAL, which is a market neutral anti-beta fund. This is very useful in constructing a portfolio because it provides a sort of built-in hedging idea where on its own the fund is not particularly useful and not particularly profitable, let's say, but its behavior, especially within the context of 4 other ETFs, is to act as a way of subduing or suppressing the beta, which obviously has the advantage of reducing the overall risk of the portfolio. We then have this XLE, which is an energy sector fund, XLF, which is for the financial sector, utilities, and this is another US-based fund from MSCI, which is based on the idea of momentum. So over here you can see these were the annual performances of each of those funds during 2023. There's the actual performance. Then what I did here was to construct a forecast for what I believe will be how these 5 ETFs are likely to perform in 2024. I could be wrong, of course, but at least we have to start from certain assumptions based on the prior year, based on our outlook, let's say, for this year, taking into account various macroeconomic factors, etc. Now you can see there's a lot of data on the screen. So the first idea is that the fund manager, let's say it's myself, has $1 million exactly to allocate to each of these 5 ETFs. The first idea is that we're going to essentially allocate an equal amount to each. So we are going to take $200,000 and allocate it to each of these ETFs. We are going to use as the initial price the price at the beginning of 2024 on that date. And we can then determine how many shares we should own, which will then result in us having a $200,000 position in each. We then take this row here, this is the forecast gain or loss, which is based on this row here, where I basically take each of these and allocate it back on a day-to-day basis. And these are the percentages. You can see the forecast is that this ETF is going to be return 0%. I'm basically making it neutral, and thereby the daily percentage on average will be 0%, and likewise for each of those particular forecasts. What I want to do next is to identify certain key features of the overall portfolio. And what I'm going to do is based on the idea that we looked at earlier, where the idea that risk is not nearly as variable over time. You remember the 4 decades we looked at. I'm going to basically make some assumptions about the risk during 24 not being that dissimilar to what it was in 2023. Now the performance, the P&L during 23 is quite a bit different from, in my forecast, from what it was in the prior year in 23. Now, what I want to do next then is to use a built-in feature within Excel, which I'll come to in a moment, known as Solver, which will then optimize the allocations that I'm going to give now to the number of shares or the position size I have for these 5 ETFs. And as you can see here, the daily return for the equal allocation to 200,000 gives me a daily return for all 5 of 317, with a return overall for the portfolio of $80,000. But based on now looking at 2 things really, one is what's known as the shortfall or expected shortfall that arose in 2023, which is calculated elsewhere in the spreadsheet, but I won't go into that right now. It's been covered elsewhere. I see that on an equal weighting basis for 2023, this number came to just a little less than $21,000. And I'm going to assume that essentially my forecast, which is based on those percentages, and when I calculate that and reallocate or optimize, in other words, the amount that I'm going to give to each of these 5 will then match on a day-to-day basis the expected return or the forecast return. And once I do that, I'll show you how I do that. I want to first of all show you how Solver works. Now, Solver is a feature within Excel. It is usually part of the basic installation. So let me bring up Solver. It comes in the form of a dialog box. And you can see here that what I have done, by the way, is I've put some constraints on the size of the positions. So the minimum allocation to each one of the ETFs is 10% of my million, so 100,000. And I cannot allocate more than 35% or 350,000 to any one of the ETFs. That is all covered in here in terms of these constraints, and the other idea is that the portfolio must be fully invested, so all $1 million must be allocated to the 5 ETFs. Now, the next thing I want to do is based on my projection or my forecast, if you wish, and based on carrying forward the prior risk characteristics as seen in 23, I want to then allocate against the 5 ETFs, so they no longer would be at 200,000, they would in fact change. I want to allocate such that I can maximize, this is what Solver does, the value in this cell here, which is highlighted. You can see it's K12. And this essentially is the Sharpe ratio. The Sharpe ratio is being based on all kinds of other calculations that are going on within the spreadsheet. And if I click on solve, which I will do now, I'll just move this slightly out of the way, it tells me that I have a solution. And you can see now that what it has done, it has changed the allocation so that, for example, this is no longer 200,000, it's gone to that, this is down to 100, and you can see the numbers on here. And in each case, it's met the constraints that I mentioned over here. I now have a Sharpe ratio, which is 1.13. I now have an optimized portfolio, which, based on the forecast, is going to deliver 97,000 or 9.74% versus what we saw previously. And you can see that the allocation has in fact changed between the equal weighting and the optimized solution, based in this case on maximizing that ratio there, the Sharpe ratio. The other idea, which is similar, it doesn't give exactly the same result, is to take the forecast gain, which I've explained how that works already, and see how we can maximize that amount that would be resulting if those numbers were to be achieved against the expected shortfall amount here. And that is the ratio that I am showing here. So let's do the same. I'll do it again. Let me bring up Solver. And now I want to change, instead of maximizing the value in that cell, I want to maximize the value in that cell. As you can see, it's already changed to K10, which is this ratio that I just discussed. And now let me also click on Solve. And we have a solution. And as you can see, this has actually generated an even better return, or better optimization effectively, because I will now have that ratio has moved up to 5.7. The Sharpe ratio has come down a bit, but also the forecast gain of now 115,000. The portfolio volatility, which is annualized here, these are the two numbers here. The ratio between these two numbers here is essentially what the Sharpe ratio is. And we now have, once again, we've met the constraints. We have a very simple idea now, 100,000 allocated to these two, the maximum 350 for that, another 100 for this, and 350 for the momentum-based ETF. So in essence, what we can do is, based on the earlier discussion in this screencast, that the risk characteristics will not deviate significantly. So we can use essentially the broad risk characteristics from 2023. We plug in our forecast for 2024. That gives rise to a kind of forecast expected gain, if you wish. And then we can set about maximizing these key ratios, such as the Sharpe ratio, or the ratio of the optimized P&L, based on our forecast really, against the shortfall in the prior year. And as you can see, this gives us this result here of a $115,000 gain. One other final idea that I could mention is that there is a correlation matrix down here, and that correlation is also based on 2023 data, and the assumption is that that is not going to dramatically change in, let's say, in the following year, the 2024 year. It also illustrates the fact that the point I made earlier, which is that BTAL has this very useful feature of showing itself to be negatively correlated with the other four ETFs over here, and that provides essentially a kind of built-in hedging mechanism for the overall portfolio when we construct it, which enables us to achieve quite attractive Sharpe ratios, and this ratio here. So I hope very much that you found that video to be of interest, and could I encourage you then to subscribe to my channel, the Corcoran Codex, where I will be adding similar material, and you can see the general theme of this YouTube channel is analyzing critical ideas and episodes in the world of finance. Thank you very much for watching.